Hi everyone, John here, joined by my colleague Josh. Josh, as we sit here and look back over the last 3 years in the markets, we've had a pretty incredible run. Equity markets have done well, the bond market has done well, and I think in moments like this, it's natural to have a sense of optimism for the future, thinking that things will continue on forever. So I'd love to get a little bit of a historical perspective on what the last 3 years have meant and what it may mean for the future.
Absolutely, and optimism is natural when you've seen performance as we've seen over the last few years. I'm going to pull up a chart here that has two sets of information. One is the red dots that show intra-year drawdowns, so the pullbacks we've seen throughout years, but we're going to focus more on those gray bars. That is going to show you annual returns of the S&P 500 going back over a number of years. And what you see is when you see those bars cluster as high as they've been for the past few years, you do tend to see volatility in the markets. Not that that's a prediction of a pullback in the market, but just how the market functions. There's cycles, there's run-ups, there's drawdowns, and there's rebounds. So again, not that we're calling for market volatility, but historically when we've gotten to this point, we've seen it happen.
It's almost like we need to be prepared. 3 years of strong market returns naturally may lead to more volatility. When that might happen or why, we can't necessarily predict, but we can prepare ourselves for that. So tell me a little bit about what we are doing on the investment committee to help in this environment.
Yeah, so some of the guidance we're providing for clients is first and foremost to just revisit your allocation versus your plan. What you can see is a plan that has 60% stocks has run up closer to 70% stocks just because of how well they've done. So we want to think about trying to rebalance, getting back to your targets so that we can be built for the future. Another big one is really focusing on cash needs. We talk about this a lot, but not having to sell at inopportune times. If you have an expected purchase in 2026, maybe even 2027, putting that cash into some higher yielding money markets to reserve it to the side and let your portfolio go through a market cycle.
Josh, this perspective is incredibly helpful because that is the bread and butter of what we as advisors do. We're thinking about the risk tolerance in your portfolio and how we can best match that up with your financial needs.